Hi, Larry Gaines, PowerCycleTrading.com. In this video, I want to show you one of my favorite option strategies for trading a market cycle low or a bottom. So we can use this strategy for bottoms of markets or tops of markets, and what it does is it gives you time to let the trade work out and you get paid while you wait. So this is what we call the calendar diagonal spread. So I want to show you an example that we did the trade on Apple. So let me show you the trade setup, what the chart looks like, my favorite kind of pattern, and then we'll walk through this option strategy. So I like this option, the calendar diagonal, when we've had a big sell-off. So this is a prior sell-off back on Apple back in 2018, just a massive sell-off. Okay, now when you get down to the lows, and we use a trading model to tell us when it's time to get in, but when you get into this, there's still potential that it could kind of churn sideways and not take off. So it can take some time for these to develop and then finally kick back to the upside where you want it to be. So we're kind of in that situation right now with Apple. I'll show you what it looks like, and when we get a signal for market bottom using our trading model, I'll be looking to do this particular calendar diagonal spread. So let's take a look at it where it is currently, and then I'll show you the trade setup that we did on this back in this period of time back in 2019. So I'm watching Apple closely. It's close to bottoming out. I mean, it could still have another push down here and try to retest these lows, but down around 114. But if we get a signal we're very close to it, then I'll be looking, probably the first choice would be looking at calendar diagonal, because then if it churns sideways and consolidates sideways for a while, this strategy is sell an option premium, and we'll get paid while we wait until the direction kicks in. So let's take a look at how this works. So the trade setup here was back January 31st. This was back in 2019 actually, but I wanted to show you the steps involved. So we're looking at it to move to the upside, but it could churn sideways. So the trade was a calendar diagonal, and let's walk through the trade. So I kind of think of a calendar diagonal, it's kind of like a debit spread, but instead of having the long call and the short call in the same option series, the advantage of the calendar diagonal is we're going to have the long call in this example in a long dated option, and the short call against it for the spread, the diagonal, in a closer end dated. Okay, so that takes advantage of accelerated theta decay. So in this trade, we bought the 15, so this was on January the 31st. So we went out, we bought the 15 March 165 call, paid $645 for one option contract if you did one contract. Now, instead of selling the 170 against it in the 15 March series, that would be a call debit spread, we did it closer in. So we sold the 15 February 170 call, brought in $188. So we had a cost of this trade, a debit cost, which is the maximum risk, $457. Now, the beauty of the trade is that if it does go sideways, we're going to get accelerated theta decay on this short 170 call. And so this is how we adjusted the trade to finally get into it for a takeoff, or what I call morphing into a longer directional trade. Okay, so we had on the 31st the long 15 March 165 call, shorted the 15 Feb 170, 457 on the debit cost. Now we took some partial profit on the 15th, so we closed the 15 Feb 170 short call. We originally had sold that for $188. Now it, with the market, it did churn sideways for a while, so we collected theta decay and we closed it out at 40 cents. So we took, based on closing this 188 out at 40 cents, we took $148 profit per spread. So that adjusts down our long dated here, the 215, see the adjusted cost. So we lowered this cost of the 15 March 165 call from the original price of $645, took that profit off of it. So now we have adjusted price of $497. Then at the same time, we rolled up and out. So what we did was we shorted the 1 March series 175 call and brought in $105. All right, so the original trade, we had shorted the 15 Feb 170. Now we rolled up to the next option series plus up to the next strike price 175 and took in 105. So our adjusted spread cost then was, we went from the we have now an adjusted cost of 497 minus that 105. So we've got the adjusted spread cost of $392 or $392 per spread. So what we ended up doing then was on the 22nd, the market had shot up pretty strong, and we were able to sell this calendar diagonal adjusted spread off at, it was trading at $807. So we took it and we sold the 807 less our cost of the trade, $392. So that gave us a $415 per spread profit, or 106% return on our risk. So let's take a look at the chart one more time, and you'll see how this can really turn a kind of a sideways trade strategy into a kind of what I call morphing into a long directional trade, either up or down. So in review, we got into the trade, set it up on the 31st, and then you can see it had a nice push up to the upside, but then you can see how it moved sideways. So while it was churning sideways, we were collecting kind of, you could say, rent by the short strike, and we then closed that out for a profit right here on the 15th and let it run a little bit more and closed out the whole trade here on the 22nd for 106% return. So getting paid while it waits. Now we could have maybe even adjusted it further, and this one could have been even bigger, but that's the basic strategy, and it's really great for a cycle low, what I call cycle low reversals, where you get a big sell-off and you're looking for a trade strategy that could kind of get you paid while you wait until that direction kicks in. So if you like this type of option strategy, make sure to join us at powercycletrading.com. Good luck trading.